Hi, this is Michael with Back to the Future Trading, and I want to talk to you a little bit today about a tool that we built that works in a longer-term swing trading environment. I'd had a meeting a few days ago with a customer overseas who said that he traded the pound dollar, the pound Australian dollar, and he was looking for ways to explore higher probability entries in terms of swing trades where he was in the market for 3 days or longer. And I introduced him to the Flux daily cycle marker indicator. And let me walk you through how this works and propose a swing trading strategy that may work for you if this is the kind of system that you're looking for. In the upper right hand corner of the screen is a text message, a text alert. Everything, or at least most everything we try to do here in terms of building tools for traders involves a predictive note or a predictive nature for identifying higher probability moments in time in the future that should theoretically push your trade in a positive direction more often than not. And so in the upper right hand corner, you'll see that there's a message telling us that a phase 3 event will occur in 6 hours and 58 minutes. So let's talk a little bit about what the different phases are so you can understand better what that means. There are 4 phases in the program that repeat cyclically, sort of like 4 seasons in a year or 4 quarters of a sporting event. And the first is a small green dot, or at least that's how I've got mine painted. And that's set up as a phase 1. The signal immediately to the right of that is a phase 2 event. Just to the right of that is a phase 3. And then just to the right of that is a phase 4. And then those cycles repeat in ad infinitum forward out into infinity. And so the software is identifying when in the future the next phase is going to occur. And so you'll see here the upper right hand corner is warning us, hey, in 6 hours and 57 minutes, we're going to have another one of these little red dots. And you can get a feel looking backwards into the past of the pair or the market that you're trading, what that would entail. What does a little red dot generally do? What does a phase 3 generally produce in the markets that we're watching? And so I started working with this customer overseas who traded the pound Australian dollar. And one of the first things he said to me, Michael, was, well, there's a lot of signals here. And for his personality, he didn't really appreciate having as many of those notes as you might say in the song. And one of the things that we did that I found was particularly fascinating, we turned off the little dots. He said, I just want to see the big phases. And let me show you what that looked like when we took the smaller phases off the screen. Now remember, we know when these events are coming in the future. There's that alert. So every one of these signals was a signal that we knew about in advance before it got here. We had days to plan and be ready for those signals. So I asked him if he was averse to looking for trend entries, because most of the customers that we work with are or a lot of the customers, I should say, that we work with who profess to be successful traders will, at some point in the conversation, describe a trend trading strategy, trading in the direction of the flow of the market. And one of the ways that I've been analyzing trend for years involves a 120 period exponential moving average, 120 EMA. And so he wasn't averse to a strategy that explored those conditions. And I just want to kind of put down some basic rules for you real quick. Number 1, when the trend is moving up, when that line is green, we're going to be looking for phase 2 signals or green dots. When the trend is moving down, we're going to be looking for phase 4 signals or large red dots. Okay? We're going to be using the dots themselves as stop levels. The centers of the dots will be a stop level. Now, just a word. In the actual indicator, you can set the dot separation distance. And that's where this parameter comes in. The marker dot separation is currently set to 200 pips away from the high or low of the candle, depending on whether or not it's a red dot or a green dot. So a red dot will have a spacing of 200 pips above the high of the candle when it closes. A green dot will have a spacing of 200 pips below the low of the candle when it closes. And these are user definable depending on your tolerance for risk and the volatility of the pair or instrument you're trading. So let's go back and explore a strategy that follows in those constraints. So for example, on the left hand side of my chart, starting here back in September, we have a phase 2 signal. And if we draw a stop through the center of that dot, I usually advise traders to put their stop just on the other side of that line, because there's nothing worse than having your stop touched to the tick and then see the trade reverse and go in your originally intended direction. So your mileage may vary. Pick which one fits your personality profile. I would recommend looking at a stop just on the other side of center of that dot. Okay. The close of the candle will then be a possible entry point. And we're going to use that here in our rudimentary trend trading system. Once you're in the market, or once that candle has been engaged, we're watching for the close of the opposite color signal. We're watching for the close of the opposite color signal, or the stop to be hit before the next signal is engaged. And so you can see the next signal in the sequence from the close of this candle down would have provided a stop of 182 pips. The next signal that would have been engaged would have been this one right here. And we'll just draw a blue line through the center of that dot. Very simple, very rudimentary. And then we're looking again from the close of the signal candle to the close of the opposite colored dot. And so in this case, you'll see there's a winner of 158 pips, a loser of 182 pips, and then a winner of 387 pips. And here's where things get interesting. Once the trend begins to fully form, we see that there's a selling pressure or a phase 4 signal here, but it closes below the moving average only several bars later, in this case 5 or 6 bars later. In that case, you would put your stop 2 pips above the high of the candle that closed below the moving average. And again, we're looking to hold that until the close of the following opposite signal, in which case that would be 150 pips positive. A very similar thing occurs on the next signal. We have a phase 4 signal, but it's above the moving average. And so in this case, your stop would be 1 pip above, or 2 pips above rather, the candle that eventually closes below that MA right there. So that would be your entry. And then your exit would be at the close of the candle on the opposite colored phase. In this case, the green dot. Okay, so one of the things I just did was realize I missed a signal. We had a phase 2 here that eventually closed above the moving average, and this signal here would have given us an entry with our stop just below. So there would have been a loser there. Always important when you're backtesting to make sure you don't cherry pick your signals. So that's a 355 pip loser. So we have winner, loser, winner, 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 loser so far. And now the trend starts to develop more. Again, stop through the center of the candle, exiting at the close of the opposite colored signal, for a 308 pip winner. And I'm just going to walk my way through here without drawing those lines. So now that you understand the system, from red dot to green dot is an 821 pip winner. From red dot to green dot is a 387 pip winner. From phase 4 to phase 2 is an 89 pip winner. And then we can see here that the stop is in fact hit. Then we have another trade engaged here, and then the stop is in fact hit. The next signal comes, makes it almost up to the center of the dot, but then closes for a 39 pip loser. We have another signal here that closes for a 150 pip winner, and I'm just working my way through the signals as they would have occurred and what you would have seen in terms of profits had you waited for the next signal, which you knew when that signal was coming next because of the text warning in the upper right hand corner. And so I'm just walking it through, tracking the winners and losers, just backtesting to see if we had followed this strategy that's based on leading indicators as opposed to lagging indicators, what would that have done for us over a significant period of time? And this starts to make a compelling case for leading indicators as opposed to lagging indicators. And now we're in an uptrend again. And the current signal is just 55 ticks underwater right now and still maturing. And we have 7 days and 6 hours until the next red dot occurs in the pound Australian dollar. So let's keep track of the wins and losses. The first thing I'm going to do is add up all the winners. 158 plus 387 plus 150 plus 410 plus 308 plus 821 plus 387 plus 79 plus 150 plus 466 plus 268 plus 963 plus 758 plus 387 plus 95 plus 552. So those are all the winners, 6,339 pips. Let's subtract the losers. Minus 150 minus 347 minus 260 minus 39 minus 253 minus 363 minus 355 minus 182. So the net total from August, September of 2015 to current, about 2 years, is 4,390 pips. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 winners, and 1, 2, 3, 4, 5, 6, 7, 8 losers. So 16 out of 24 is 67%. And in our webinars, when we ask people what their accuracy is with the software that they're using, or when we're tracking the predictions versus what happened after the fact, these numbers tend to appear as the answers fairly consistently. And when I ask people, did your results appear in a 60 to 70% window of accuracy, many times customers will say yes. Very simple trend entry system, 2 indicators, very mechanical, no discretion. And so I would encourage you, if you haven't explored yet, the opportunity to work with predictive indicators as opposed to lagging indicators. These are the tools we believe banks are using to pre-plan when they will make moves in the future. And when they're ready, when they actually make those moves, we're sitting there, metaphorically speaking, when they open the vault And when they take money out, we're there catching the crumbs as they move those massive piles of equity around. If you have any questions about this particular system, or you want to explore how your pair or instrument would do in an environment like this, please email me, michael@backtothefuturetrading.com, or visit us at our website, backtothefuturetrading.com. Thanks, everyone. We'll talk.